Happy to introduce today's moderator, Dan Vermeyer, an investment banker with Corporate Finance Associates in the Dallas office. Dan has vast knowledge of the middle market across all industries. Dan, thank you very much for moderating today, and I'll turn it over to you.
Well, thank you, Daniel, and good morning, everybody. Appreciate you attending. It's great to see so many faces and names. Even though we're virtual, it's kind of great to get together like that. I'm excited to be the moderator today, and I'd like to introduce the panel. We have three experts in the private equity sector in no particular order. Maybe this is alphabetical last name, I guess. Brendan Acheriakasol with Ardenton. Brendan is the director of private equity for the US. Ardenton has long-term capital in both in Canada, UK, and the US. And their portfolio is fairly broad in technology, the food industry, and industrials. Also, we're lucky to have Ben Eakes with Crossplane Capital. Ben is the co-founder and partner of Crossplanes. They are a value-added strategic partner, primarily for industrial companies at this point. They look for companies that are family-owned or have some sort of complex situation. Their portfolio includes Transaxle, which is the largest East Coast distributor of remanufactured transmissions, and Accent family of companies, which is value-added distribution in the waste and recycling area. And last, but certainly not least, is Grant Cornman. Grant is managing partner and founder of NCK Capital. They help take companies to the next level with capital structures that are the right fit. Grant has a brother as well in the organization, and I'm not sure, but I think everybody says Grant is the better looking and the smarter one, so we're very lucky to have Grant with us today. Now, our panel today is going to be discussing trends and perspectives in private equity, especially with the COVID crisis. And as Daniel mentioned, here at ACG, we run this PEG panel once a year, and it's really a very popular event. But if you think about looking back, even just the 1 year ago, or maybe even just 9 months ago, who would imagine the dramatic changes that we've seen in the world as a whole and in each of our individual lives? And certainly dramatic changes and a shock into the M&A industry. If you look at a lot of different industry reports, you generally see that they say April was probably the bottom of the crisis in M&A in terms of transaction values and deal volumes. Some reports say that April was as low as 70% below the level before the COVID crisis. That's pretty astounding. But since April, we've seen good growth all the way through August in both transaction count and in values. Many would say that the worst is behind us in the M&A industry, but I would ask, is it really? The world wants to go back to normal, but there are a lot of things that will never return to that normal. And there are some things that are happening that are just really strangely different, but look like they'll continue that way for a while. There have been some unusual, but yet very positive things. For example, some manufacturers pivoted to manufacturing personal protective equipment, PPE, like masks and sanitizers. But that business is not as temporary as you might think, and industry expects PPE to continue growing at an 8% CAGR through 2025, right? Who would have thought? If you look at a lot of industry sectors, you'll see pockets of strength like technology, which is where I spend a lot of my time. But also there's pockets of total devastation like the airline industry or the hospitality industry. So really have to be wary out there. So the question is, how has all this affected M&A deals? How's it affected the process, the timing, the valuations, the deal structures, and access to capital? And that's why we have a panel of experts today, and that's what we're going to talk about. And Ben, I'm going to start with you. And we're going to talk for a little while here about deal flow and sectors And I'm wondering, in your experience, have you seen deal flow now in July and August perk back up from the way it was in about April timeframe?
Sure, you bet. So April, I think as everyone noticed, I mean, things just hit the skids from a deal flow perspective. May, we saw it still pretty slow, but very noticeable uptick in June, July, into August. Very noticeable increase in activity of new transactions. You certainly saw some that were, it's a mixed bag. It was deals that were put on hold, that came back. Actually, deals that are benefiting from the COVID effect. And then there's a number of sectors that we can get into as to which those are. I think probably a lot of folks know which those might be. And then I think just there's other factors that are driving some kind of increase in M&A activity. But I think people kind of learning how to kind of live with this in the kind of deal context, whether it be virtual management meetings and so forth, trying to figure out how do I diligence this company from afar, so forth, is really helped. I think people have kind of started to get their arms around that. So we have definitely noticed, an uptick in overall kind of deal activity since that low in April. It went, bone dry there, and a lot of transactions, obviously, that we were looking at in the February, March timeframe just were shelved. It was a really interesting time because as you looked at the transaction historically, think about where we were in February. You looked at a company a certain way, and then all that we know that happened, well, you can no longer look at that company in the same way anymore. And so our view on things have certainly changed in terms of how do you get comfortable from a diligence. I know we're going to get into that, but the answer to your question is, it's a very noticeable uptick in deal activity.
Interesting. Thank you. Grant, maybe to you, if we're seeing some uptick in deals, what have you seen with the money supply? Is it still strong money, and is it tend to chase fewer deals, or what are you seeing in the balance there?
Yeah, good. That's a great question, Dan. I think it depends on the business that you're talking about. Companies that have sailed through the pandemic unaffected both positively and negatively seem to be getting a bit of a premium today in today's marketplace. I think people are starting, and that we are, to look at businesses that were impacted but have demonstrable signs of recovery, and getting creative in how you look at those. I think it's tougher on businesses that maybe had a great windfall from the pandemic. I think a lot of capital is really staying on the sidelines for those opportunities right this second. Credit markets seem to stabilized a bit in the lower middle market, which is where we play. Total leverage ratios are still kind of below historical norms, but lenders are telling us they're thinking about edging back up to where they were, as long as there's sufficient equity in the transaction. But unfortunately, with senior lenders, until you get a term sheet out of them, you don't really know. But that's the feedback we're getting.
Interesting. Brendan, maybe a little different perspective here. I know you guys play in a lot of different sectors, and have you seen some sectors recover faster than others, or generally is the M&A market about the same?
No, it's definitely not the same, and there certainly are sectors that have recovered more quickly, and some sectors that you expect will recover more quickly. I mean, for example, we are in the process of looking at a dental practice. If you look at their financials through the spring, zero. I mean, they're zero revenue, and most of them were just hanging on through some PPP money that helped them to allow to pay out their staff. But are those sectors going to come back? Well, yeah. I joke a lot of times that I've hit executive platinum on Zoom, but I guarantee you I'm not going to start going to the dentist virtually. Although my kids might enjoy trying to do that. Once things allow, I'm definitely going back to the dentist, and I think everybody else will too. So there are some areas that the COVID crisis and sort of everybody being in quarantine has put a drastic pause on revenues and earnings and profitability of those businesses. But you can certainly see the other side, right? I mean, and you know, I think Dan, you and Dan both sort of mentioned some of these. And then, you know, on the other hand, there's also some areas that who knows, you know, who knows what's going to happen with the airline industry or hospitality or retail. You know, and you think about it, who knows what's going to happen with commercial real estate? I mean, everybody has gotten very comfortable. I, for one, was never a guy that liked to work from home. I hated working from home. I always felt like I was missing out, and you know, my kids drive me crazy, particularly during the summer. But you know, there has been a change in my mindset, and I think in probably a lot of people's mindsets, and how the world, what the new normal really is going to be. You know, so I think there will be some sectors that will not come back as quickly, and potentially may never come back the way that, you know, the way that it was. So to Ben's point, not only are you looking at deals and companies differently, you're not just looking through it at a different lens as of today, but you're looking at them through a different lens, you know, into the foreseeable future.
Interesting point. So let's think for a minute, if you do crack the code on some sectors and you feel comfortable with them, and you see some deals in those sectors that look interesting to you. Grant, I'm going to ask you, because of the COVID crisis, has it caused you to change your approach to the deal in terms of structure or owner participation or what have you?
Just to clarify, Dana, are you asking, has COVID impacted deal structures or doing a deal and diligence in general?
Let's take the first one. Have you found that COVID has impacted your approach to doing the deal in terms of deal structure?
You know, I think it comes down to the performance of each individual business. You know, we are working on several right now that, you know, if you look at their financials, their TTM revenue and EBITDA, you'd say, what pandemic? And so I don't think there's any changes there. You know, there are other businesses we're looking at that, to use Brendan's dental example, you know, it was severely impacted, but it has a road to recovery. And so, you know, an earnout or some kind of deferred compensation structure makes a lot of sense. I had an interesting conversation yesterday with an owner of a potential add-on. You know, we've been kind of flirting for, you know, a year now, and you know, he's kind of tired and ready to exit, but he's like, I don't want to give away my business. You know, is there some way where, you know, we can, you know, make this happen now, but I have some upside over the next 12 months. And, you know, that's what earnouts are great for. You know, he did raise the point, well, there's some risk there to me because you guys could screw things up. and I said, well, you know, we really try not to do that. But it is a risk, and you know, that's just something he's going to have to weigh. You know, is exiting today because of he's older and he's tired, and you know, for a man of his age, you know, going to the office used to be fun, and now it could be a health risk, and so he's just having to weigh all those factors. So yeah, I think it depends on the business, and I think all private equity investors are, you know, going to be dusting off our creativity hats, you know, this year and next year to thread the needle on these types of situations.
Thanks. Brendan, what about you? Do you see earnouts as a more common thing now? Have you done any deals with earnouts lately?
Yeah, no, absolutely. I think absolutely so. We are adding more earnouts, and maybe even, you know, a little bit heavier earnouts in our deals currently. And you know, really, it's to give the owner a little bit of the benefit of the doubt. I mean, you've got an owner that says, hey, look, you know, look at 17, 18, and 19, and this is what I was doing, and I'm on this trajectory, and things are going great, and all of a sudden COVID hit. Well, you know, this is still a great company, but you know, maybe my financial performance and my trailing 12-month basis is going to be down. You know, how can we fill the gap between what you want to, what I want to pay for the business, and what he thinks is the business is worth? And so we try to use earnouts and different elements of structure to sort of fill that gap. And effectively, what that's doing is saying, hey, okay, we'll give you some benefit of that doubt, but you're going to put your money where your mouth is, right? And you're going to earn some of this, based on the projections that you've told us that you're going to hit, and we're going to give you, some valuation benefit for doing so. So yeah, we've got we certainly are using earnouts a little bit more, and probably probably a little bit deeper too into the valuation. Also equity roll too. I mean, to Grant's point, you've got a guy that, an older gentleman or lady, whomever it may be, and they're more than happy surviving through this. But they want to bring on a partner. They want to de-risk a little bit now, and they want to bring on a partner that can help them sort of develop and work their way through COVID and whatever the economy looks like post-COVID. But he doesn't want to go home. So I've got a colleague who always says, it's a statement that his wife says about a guy that retired. And he said, the wife has said, "Hey, I married you for better or worse, but not for lunch. Go find something to do during the day. Don't just sit at home." So, I think that mentality actually kind of holds true. Like people want to continue to work in the business. They want to bring on a partner that can help them de-risk that business and help benefit, operationally. So, having a little more equity roll post-transaction actually kind of suits both of us in those situations.
Yeah, it's a good
Hey,
point.
Dan, I got a question for you on that front.
Yeah, thank you.
And Brendan, I'm curious to hear your thoughts. We're seeing more and more sellers just come to the table of, hey, we want to roll equity. We believe in the second bite of the apple. And we're kind of wondering to ourselves, is that because maybe valuations are lower and so they're, really do want the second bite of the apple? Or is the dynamic shifted a little bit more back towards the buyer? It's still a seller's market, and bankers are doing a good job coaching clients about, hey, to get a deal done today, you got to check some more boxes. And, one of it is rolling more, staying around. I'd love to get one. Brendan, are you seeing that more and more? And Dan, do you think is a product of bankers really coaching clients more than their intent or desires?
Well, obviously I think that investment bankers are very good at everything, but at coaching clients. But you've hit on a good point. I was trying to think about how to bring that up, but it takes a pretty sophisticated seller right now to see beyond the moment, and there's just no way, for most businesses, there's just no way you can give them a full valuation and let them exit right now. And so the sellers that want to exit, they're going to have to compromise in some other way, in some other area. On the other hand, if they've got a lot of juice and experience and they've got a lot of energy for the business and want to stick around, this could be a perfect opportunity to partner with a financial partner, take some chips off the table now, but enjoy the bigger upside later and take advantage of the dynamics of the industry. I think if anything, this shockwave in the industry may have scared some of them and made them realize that they don't want to go it alone and they do want to have a sophisticated partner in the boat with them. But that's a challenge. Some sellers just don't believe that this has had an effect on their valuation and their opportunity for the deal, and they just want to, why aren't you bringing me a deal that looks like this? And that can be a challenge. Brendan, your thoughts on that?
Yeah, great question, Grant. We are seeing deals come to the market where there's a lot more, where the seller is openly saying, "Hey, I'd like to roll more." And I think there's a couple messages that I read into those. One is, yeah, maybe he does want a partner. Maybe he is truly looking for, a partner for growth into the future, and he sees a lot of potential. We get a lot of deals that, they've been bounced through, some strategic buyers, and they don't like the way that looks and feels. And so they're like, hey, somebody like Ardenton, a long-term, financial buyer with operating expertise might be exactly what I want. The other side, on the other end of the spectrum, is sometimes we're seeing some where they're just wanting to sell a minority interest, where maybe they're only selling 25%, which for one, that's not my mandate and I couldn't do it anyway. But the thing that comes to mind there is, what are you selling for? Or is that a little bit of just a little bit of a bailout? Just looking for a little bit of bailout capital to get you through the next several months. So I think like everything, it's good with moderation, and when a seller comes to the market and he wants a partner and he wants to remain involved and remain in the equity side of things, that's always a good thing, but with moderation.
Mm.
I just think if I was a investment banker today and a client was looking to sell their business, I have a pretty simple question, which is, hey, do you want to exit in the next 1 to 3 years? And if the answer is yes, doing like a majority recap where you own 20-30% of the business today makes a ton of sense. Who knows what's going to happen in the next 36 months, right? For us, we're longer term investors. There's ups and downs. If it goes down a little bit, great, we can kind of ride it out. But if you want to exit in the 36 months or less, it makes sense to take some money off the table today and then have some upside through a rolled equity piece over the next couple of years. Not to mention just the potential tax changes that could be coming down the pipe.
Yeah, for sure.
Yeah.
Well, Ben, welcome back. We were just talking a little bit about what might be going through the mind of some of the sellers and how the current market may change their opportunities or their views. What I'd like to do right now is shift gears just a little bit and talk about some nuts and bolts about valuation and constructing a deal. Let's say that you found a sector that you're comfortable with and you have a deal in front of you that might be interesting enough. But this company had some effects of COVID. And so my question is about how do you value that business? They may be showing a really high EBITDA right now because they started making hand sanitizer, and you don't know how long that's going to last. Or maybe they're showing an incredibly low EBITDA because they were in the bicycle business and they can't get any bicycles right now, or something like that. So there's, I guess, conceptually some positive EBITDA adjustments and some negative EBITDA adjustments. And this concept of EBITDA C, that we've all seen and laughed about, but it is true. There's effects from COVID on somebody's EBITDA. And how do you figure out, will that last or not? Do I give them an adjustment one way or the other for that? Ben, maybe you have some thoughts about specifically valuing and figuring out a company that may have had some effect from COVID.
Sure. Can you guys hear me okay?
Yeah.
Yeah, technology is a wonderful thing until it doesn't work. So my apologies for that. Just went like Zoom blew up on me. So sorry about that. But yes, we certainly have seen that. I think more along the lines of the negative, the positive adjustment, if you will, for COVID related expenses that a company may have incurred over the past, particularly, kind of the April, May timeframe. And those, if they're identifiable and you can explain them where it's excess, costs associated with PPE or whatever the case may be, cleaning a facility, if they're identifiable and quantifiable, we'll definitely give you the benefit of the doubt for that. I mean, our whole view, if it was a good business before the pandemic, it's a good business, likely going to be a good business post-pandemic, So that's how we look at it. Generally giving them the benefit of the doubt on those tangible kind of costs incurred. I think where the creativity comes in is, what would my EBITDA have been, and what performance have been, absent COVID? Can I get a COVID related kind of one-time adjustment? That's where you really have to kind of work with them. It's okay, I'll give you the benefit of the doubt. Yes, you saw kind of an impact, but you're creeping back and you're back to seeing some positive EBITDA, whatever the case may be in the more recent months. And that's where I think you can kind of get your arms around that type of adjustment as well.
Interesting. Brendan, what about you? How do you handle EBITDA adjustments, positive or negative? And here's a question that feeds into this from Allison. Says, how would you calculate the positive or negative adjustment? Would it vary based on the industry? Brendan, you seem like a smart guy. Let's ask you that.
Looks can be deceiving. So this is one where the strategy is very simple and the tactical is more difficult. And to answer the question, you know, and I talk to guys all the time, and they're like, okay, what are we worried about? What are we the most interested in seeing? Do we want to see what 2019 was, or 2018 was, or 2017, or trailing 12 month, or, you know, the second half of every third quarter in the last 10 years? Like, the answer is no. I don't care about any of that at the end of the day, because what I care about is what it's going to do after I buy the business. All that I'm using historical financials for is to give me an indication, hopefully, of what's going to happen after I buy the business. So at the end of the day, all I'm trying to do is figure out what's it going to do on day 1 through year 20 post transaction. So, you know, there are some companies, and I'll go back to my dental example. Trailing 12 months for a dental business is horrible, right? But if I bought it, you know, today on the valuation based on what it did in the trailing 12 month, I'm getting a heck of a deal, because we all know or think that that's going to come back. Post transaction cash flow is going to be very similar to what it was before. Now there are companies where that's not going to be the case, and there are, and you know, and getting to your question on kind of the adjustments, you know, there are some very reasonable adjustments. I looked at one, and I would look to my accounting friends here on the call. I would argue that maybe there's a little bit of fraud going on, but they had calculated in their assessment of the of the forgiveness of their PPP loan as income. Clearly not the case, right? I mean, this is a very clear example of something that needs to be adjusted out. I mean, but in another example on the other end, you look at a company who, let's say it's stabilized. Let's say the revenues are going very well, right? And they're continue to have good, strong earnings. However, if you look at their expenses, EBITDA might be up because their expenses might be low because nobody's traveling. What is their budget and travel entertainment expense over the last 6 months? That's probably pretty close to zero too. So in that instance, it's going to be a cash flow adjustment that's going to reduce your earnings into a more stable period. So, you know, there's probably a couple handful of examples to go through, but at the end of the day, all that I'm ever really worried about is what's going to happen after I buy the business, because that's the cash flows that I have a claim to, and whatever proxies I can use to get there. Just be smart about it and be thinking about it, and make sure that whatever adjustments you're making are adjusting out things that aren't going to happen again.
To add a little bit to that, I'd love to get Ben and Brendan's thoughts on this. You know, we tend to have more comfort with a COVID adjustment if it's been validated by a third party beyond the investment bank. If there's a sell side Q of E that's done a thoughtful analysis and has supporting data and can prove out that adjustment in a way that a buyer is really going to accept, I think it just builds a lot of credibility and improves the likelihood of buyers accepting it. I think, and Dan, I know you would never do this, but some investment bankers and sellers take, you know, pretty egregious positions on some of this stuff, and it just creates a real disconnect between a buyer and seller in today's marketplace. I mean, right now it's going to get better fourth quarter Q1, but right now it's a tough time to transact. And if you want to sell your business, you should be thinking about, hey, what can I do to build credibility with buyers today? And there's a lot of capital still looking for a home, and so people are still willing to pay really strong valuations. So you should be asking yourself, hey, I need to do everything I can to make my business as attractive as possible and take away barriers to the transaction. And one of those is just having really good numbers. So if I was an investment banker today and I had a lower middle market client who wanted to go to market without a sell side Q of E, I would say, gosh, you know, you're not willing to spend 50, 60, 70 grand to get 20 million. You know, it's a very easy ROI. It's kind of like, you know, it's like buying a used car and letting the buyer take it to another mechanic right before they're about to give you the money. Like, you know, it's just taking the leverage out. And we're a little different, and more times than not in our investments, sellers are our partners in one shape, way, or form in the future. Either they're board members, they're friends, they're, you know, co-investors. And so we really see transactions as, you know, win-win. It's not a zero-sum game. It's not, you know, the seller makes more money, the buyer loses more. I mean, it should really be a balanced transaction. And for us, that's having good information. We want a seller to feel good about their transaction because they're going to be our partner going forward. Just like I hope they want us to feel good about what we paid for the business because we're more likely going to be partners in some way.
Yeah. Well, you're right. I mean, you need to come together and build that relationship. And obviously, I would never take any kind of an egregious position. That's why they call me down the middle of the road, Dan. You know, and that's. We have a couple of topics here to talk about, and I've got a really good question coming up. But the next couple of topics are about how COVID may have impacted the M&A process. And Grant, I want to start with you because I'm told that you pay more but also close faster than anybody else in the industry. And so I'm wondering, have you seen COVID impact the process? And in particular, how about face-to-face meetings and traveling and kicking off due diligence and that type of thing in the COVID environment? What have you seen there?
Well, first, I want to address your first claim. It's 100% true that we pay more and close faster on all companies we buy. It's definitely impacted the process. Management meetings, we're having a lot of virtual management meetings. We are traveling to management meetings when they'll have us. We're working on one potential investment right now that, the process kind of started back in March, and they're based in the New York metropolitan area, and we were having long discussions about, hey, are we willing to go to New York right now to look at a business? Flash forward to the summer, now we're talking about going to see them, and the question is are they willing to have Texans to come see them? It totally flip-flopped. Virtual management meetings are good. I don't think anyone will agree they're great. In the kind of businesses we're buying, relationships count so much, and it's very hard to build a rapport with a seller. We went to one over the summer where the majority owner and CEO did not turn on her video for the virtual management presentation, which made it a little even tougher. I think deals are getting done. We're all figuring our way through this. I think there's more of a comfort for diligence professionals to work remotely than ever before. But I still think there's an importance for, the principles of transaction to spend a little face time together. And we most sellers that we've been interacting with are really okay with it. They don't really have much concern. Their biggest concern is, hey, maybe we do a tour of the facility after hours, just so we don't risk some kind of broader contamination of the facility, which makes total sense.
Yeah, you bet. Interesting. I know from our perspective, travel is just now starting up again. We had no travel for probably 3 or 4 months there, and it was weird, and it was weird making everything Zoom. So, Ben, I'm going to ask you a question or two here. And this is partly a question that was generated by my friend Michael Alagan, who I think y'all know.
Oh boy.
In our little warm-up, we talked a little bit about perhaps special situations, or is there a coming wave of special situations? And so if you think about it, private equity groups are in the business of deploying capital from their LPs. And so have you seen, or have you at this point started shifting your strike zone to include more distressed deals or sectors that may be distressed, and kind of get into the special situations business? Ben, do you have some thoughts on that?
So fortunately, we're already in the special situations business, so it's not a matter of getting into it. So that's a good thing. So we're very much focused on kind of the undermanaged family-owned business where they're looking for a partner, and they're willing to roll over equity. But then also those kind of unique, complex transactions, whether it be a corporate carve-out, restructuring of some sort, bankruptcy, so forth. And we're starting to see more of those types of transactions. Now, I will say early on, not surprisingly, you saw them in the usual suspects, but everybody on this call would probably know: hospitality, restaurants, retail. You could have your pick. Energy, oil and gas. We don't actually focus on any of those sectors. More industrial in nature is where we are focused. We hadn't, kind of going through the summer, hadn't seen a lot of activity in that space, but you're starting to see more of it. And we fully anticipate that in Q4, particularly in Q1, we're going to see a lot more of it. And so, why is that? Expiration of, well, not expiration, but the full use of PPP loans, which we believe have definitely propped up some of these businesses. We think lenders are being extremely accommodative during this time, willing to kind of work with borrowers as they kind of work their way through this. But at some point, somebody's gonna have to do something. And so whether it be a family looking to kick in more money and they don't want to or they can't, private equity firm needing to kick in additional equity, they don't want to or they can't, that's where we're going to see it. And we're starting to see it. Corporate carve-outs, we're seeing more of these large corporates focus on the core business, focus on showing up their balance sheet, shedding non-core assets. We're starting to see that. And so we think that we'll continue to see it, and in that the pace of those types of transactions will increase. And fortunately, we've got a lot of capacity to and capital to take advantage of those situations. So we think it's going to be a great time to kind of acquire these assets. We think hopefully at unique values, but you got to be shaking a lot of trees and you got looking at a lot of rocks to try to find them, but they're going to be there. And like I said, we're starting to see it.
Ben, I'm going to stick with you. Just a quick follow-up. And guys, we have about 2 or 3 minutes before we'll move to the networking portion. But given the structure of a private equity group and their LP arrangements, but yet here we are in this COVID crisis. So the question is, are LPs extending their investment periods due to the slowdown in deal flow and the recession? Do y'all see any changes to the structure of the arrangements? Ben, start with you.
In terms of the fund, and could you extend your investment period?
Mm-hmm.
We haven't seen that. We're on the very early innings of our fund though, and so there's not a need to do that. We haven't experienced that.
Brendan, what about on your side?
Yeah, so we're structured quite a bit differently. We are a corporate structure and we make long-term investments. So we've always had the ability, and we've set up our structure to give us the ability to make an investment for 20 or 30 years if we need to. So we haven't noticed anything on our side.
Mm-hmm. Grant?
Well, like Brendan, that's not really an issue in our structure. So it's not something that we've been facing. I think it's probably more applicable to funds that are kind of long in the tooth on their investment periods.
Yeah.
I'm guessing LPs will be giving those kinds of extensions to funds. They don't really have much of a choice, but it's not applicable to us.
Okay. Yeah, I liked the question though, so I wanted to pass it around to everybody. All right, so we have time for 1 minute each of you. Ben, we'll start with you. Tell us what the ideal target looks like for you, but then also tell us what an advisor like Dan Vermeyer could do to help you during this time.
Okay. So our ideal targets, 40 to 200 million of revenue. It's going to be industrial business services, niche manufacturing, value-added distribution, kind of GDP growth type industries. We don't do restaurant, retail, real estate. We don't do resources like energy or metals trading businesses. We don't do reimbursement, so healthcare, where there's reimbursement risk associated with it. So basic industries, kind of 5 to 12 EBITDA. Again, back to my earlier comment, it's a family-owned business looking for a partner where they're looking to roll over substantial equity alongside us, but then also complex transactions, corporate carve-outs, restructurings, bankruptcy, so forth. advisors helping us. Gosh, look, I think now where there's what we believe is that there's going to be, I think, processes going to be more targeted and maybe more select, universe of buyers, given some of the restrictions, whether it be diligence, travel, so forth. We want to make sure we're top of mind and included in those select groups, obviously, for at-bats. I mean, that's really what it's about. I'm not sure, Dan, what you've seen, what you experienced, but that's what we're noticing is that the processes aren't broad in nature. They're actually being a little more focused. So actually being part of that group, being part of the fireside chat, getting in early on an opportunity is definitely what we're interested in.
Interesting. Brendan, to you, if I saw an ideal target for you, what would it look like, and what can an advisor like me do to help you the most during this time?
Yeah, so an ideal target for us, we're right now we're focusing on 4 subsectors of the market: IT, healthcare, food, and business services. We're sort of 3 to 15 million of EBITDA. And what's most important for us is that we have a good partner in the deal. So whether that be the founding owner, the management team, or something of the sorts. We're not replacing management teams historically, so we want a good partner in the deal. And if they could be aligned with us through an equity role, and a strong interest in what happens post transaction, that's ideal. What an investment banker could do. I mean, I'd echo what some of Ben said. Find deals that that are going to kind of fit our mandate, and in any way that we can get in kind of early. I was on the phone with an investment banker 2 days ago, and he said, "Hey, thanks for taking the call. We sent this book out to 10,000 people." Well, that is obviously not a call I want to be on. I would much rather, I'd much rather be sort of, paired up, match made, I guess, a little bit with a company that has the characteristics that would fit well with us as a partner, and likewise.
So maybe an investment banker could somewhat figure out the match a little bit better than 1 to 10,000.
Yeah, yeah, right. I'm not as smart as Ben or as charming as Grant, but I've got a couple things going for me. Hopefully, there's something that they like about me.
So, Charming Grant, what would the right deal look like for you right now, and what would you hope that an investment banker like me would do to make it as easy as possible for you?
Sure. Well, first, we focus on companies with a little bit smaller than Brendan and Ben. We're $2 to $10 million of EBITDA with an intense focus on that 2 to 6 range. We focus on 4 key industries. Service companies are our biggest bucket. That can be everything from business, industrial, environmental, facilities, tech-enabled. If it's a service company, we generally like it. Niche manufacturing, value-added distribution. And one that's a bit unique out there is we also focus on for-profit education. In terms of the right situation for us, in terms of seller dynamics, like we've bought companies from private equity firms. We bought businesses from sellers who wanted to stay involved. We bought companies where sellers wanted to toss the keys and transition out quite quickly with very limited teams. We're a very operationally focused group. My partner and I, Michael, who's also my brother, we built our own companies from scratch. And so we're a little bit more comfortable in those situations than other private equity investors. And in terms of what can a intermediary, Dan, or investment banker like yourself do to make our life easier, the fact you're asking the question is nice. I don't know if any bankers asked that question over the last 4 or 5 years. It's usually the opposite. But in all seriousness, I think if it is a situation where there's a pandemic impact, vetting your client, vetting what they're willing to do, making sure they understand what a deal is going to look like in today's world, and then being an advocate for both sides. Obviously, we're probably going to take less risk and want the seller to assume more, and vice versa. Helping find that happy medium would be really, really helpful. I know a lot of investment bankers we're talking to in our area of the market are saying sellers are less interested in a formal process. especially as they worry about a Biden-Harris administration, what that means for capital gains taxes in 2021 and beyond. And they're having sellers say to them, hey, I know what my business is worth. If you can bring me a buyer who will kind of hit that price, don't run a full process. Let's close before the end of the year or Q1 next year. We're happy to work in those constructs. And we're happy to pay and make sure that the investment bankers compensate on the buy side if the sell side's not willing to do it.
Excellent. We have about a minute or two, and Ben, there's one follow-up question here that's up your alley, following up with your other comments. If you were a seller, from your perspective, what's the one thing you would ask them to do to get their financials in shape to be more appealing in this time? Would it be lowered CapEx, improving the cost of goods sold? Is it all balance sheet? What would you look for there?
To improve, none of the above. I mean, we see those as opportunities. I mean, it's for us, it's the working capital out of the gate, focused on shoring up the balance sheet, cost optimization, and revenue growth. So, for us, we're looking for those kind of fallen angels, diamonds in the rough, what have you. It helps if I'm answering the question, or I'm hearing the question correctly. It helps me if there's more opportunity, right? I mean, if we're a seller of a business in this environment, I don't know if that's the question, but for us, for a company to improve things all of a sudden to enhance their value so I can pay more is probably not of interest to me. I don't know if that's the question, Dan, but it's kind of odd for us to go and really drive value, and that's one of the kind of where we see opportunity.
Yeah, maybe that's a topic that we could follow up with in the networking session as well. Well, you guys, I really appreciate your participation today. I really appreciate everybody joining us in the audience. Personally, I was involved in this program last year for the PEG panel, and I find this year to be really weird. And I'm anxious to see what it's going to be like next year as we reflect back on 2020 and all of the things that happened. But I appreciate you guys bringing your perspectives and telling us a little bit about how you see it from the private equity side. So thanks again. Can we have a big virtual round of applause for our panel? Really appreciate them putting themselves out there and giving us some thoughts. And at this point, I'll turn it back over to Daniel or Brittany, and we'll begin to look at the networking portion of the program.
Yeah, thanks, Dan. Really appreciate that, and thank you all for such a great panel. This was really timely information. Really appreciate it. We did record this program, and it will be available for viewing soon. We hope you all stay for the networking portion now. We're working on turning your videos all back on and sorting you into breakout rooms. We'll have 2 rounds of networking, and you'll be randomly sorted into these groups. We hope it gives you an opportunity to meet people you haven't met before or catch up with those you may already know. Christy, are we good for the first room?
Yes, we are. I'm going to move you now.
Okay, thank you.